You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is January 27th, 2026, and today we are looking at the big one, Boeing, fourth quarter of 2025. And just a quick reminder before we take off, pun intended, that Miro and I are just chatting here. This isn't financial advice, just our personal opinions, so please do your own homework.
Yeah, don't trade based on my sarcasm.
Exactly. So, Miro, Boeing, after the strike, the delays, the chaos of last year, looking at the headline numbers today, it feels like a fever dream. $10 a share in profit? Are we reading the same report?
We are, but put an asterisk next to that, a big one. Headline earnings came in at $10.23 a share, GAAP, which sounds incredible given they lost money last quarter, but $9.6 billion of that came from selling their digital aviation solutions business. So, sure, they made a profit, but mostly because they sold the furniture to pay the rent.
Right. The old sell the silverware strategy. So if you strip that out, were they actually profitable?
Operationally, no. Margins are still negative. But the revenue recovery is real. Top line hit $23.9 billion, up 34% from Q3, and that's the post-strike bounce. The factories are actually humming again.
That explains the stock reaction then, or the lack of one. I was watching the ticker right after the print came out, and it was wild.
Yeah, classic pop and drop. It spiked to like 253 in the first hour of trading, then just faded. Closed basically flat at 244-ish.
The market saw the $10 EPS, got excited, read the footnotes, and went, oh, right.
Oh, right. They sold Jeppesen.
But hey, credit where it's due. They finally cleared the tarmac. I saw deliveries jump to 116 planes. That's way up from the 116 they did in Q3. And for the first time in what feels like forever, they actually generated positive cash flow, $400 million.
It is a milestone. And maybe the most important symbolic victory, the Shadow Factory, is officially dead.
The Shadow Factory. Sounds like a bad sci-fi novel. Remind everyone what that actually is.
It's the inventory of 737s built before 2023 that needed massive rework. They've been chewing through that backlog for years. Jay Malave, the CFO, confirmed there is exactly one plane left from that batch. Just one. So theoretically, the factory floor is clean.
That's huge. Just psychologically, that has to be huge for the workforce. But speaking of clean slates, they ended the year with a record backlog too. $682 billion. It's like they have all the orders in the world. They just need to build the things without them falling apart.
That is the eternal Boeing struggle, isn't it? And look, even with cash turning positive, it's fragile. They're guiding for a cash burn in the first half of 2026, so we aren't out of the woods. Plus, there's a new scary phrase in the transcript, engine durability issue on the 777X.
Oh no, not again!
Yeah, we need to talk about that. And we definitely need to talk about why the defense business is still losing money while everyone else is buying fighter jets.
All right, let's get into the details.
Yeah, defense. The irony is thick enough to cut with the knife. For years, the narrative was commercial is the disaster, defense is the safety net, right? Well, look at the segment data. Commercial margins are still ugly, sure, minus 5.6%, but they're climbing out of the hole. Defense margins actually dropped to negative 6.8%.
Wait, negative 6? Isn't defense supposed to be this steady, boring annuity business? Governments pay bills, planes fly, everyone's happy.
Theoretically, but they took another massive hit on the KC-468 tanker program, $565 million, just in this quarter. And the reason they gave in the transcript is, well, it's revealing. They called it higher production support costs.
Production support costs. That sounds like corporate speak for we had to hire more people to fix things.
Exactly. Basically, they are paying a premium to not screw up. They have to swarm the factory floor with extra oversight and support just to get the tankers out the door without defects. It's like, imagine paying a massive tax on your own incompetence. It kills the margin, but it's the only way to stop the bleeding on quality.
So they're trading profit for reputation, which honestly, probably the right trade.
Oh, absolutely. It's the necessary medicine. But it means that defense recovery is going to be a long, painful slog. It's not a growth engine right now. It's an anchor.
Okay, so defense is in the doghouse. But let's swivel to the scary part you mentioned earlier, the 777X. That plane feels like it's been coming soon since I was in college. What is this new durability issue?
Yeah. So during a routine inspection of the GE9X engine, which, by the way, is a monster of an engine, biggest in the world, they found a component that didn't look right after flight tests, a durability issue.
I don't love the word durability when we're talking about engines over the ocean.
Now, you generally want the spinning metal parts to stay inside the casing. Now, Kelly Oberg, the CEO, was very quick to say, we don't expect this to impact our 2027 delivery target. They've got the TIA-3 authorization. Flight tests are resuming. The timeline is officially intact.
But I hear a but coming.
But this is certification testing. If you find a durability flaw now, you have to redesign, remanufacture, and retest. Physics doesn't care about your guidance slides. If that engine needs a fix, 2027 is, let's just call it, optimistic.
Right. It feels like there's this ghost of the past hovering over it. Like every time they say on schedule, the market just flinches.
Which brings us to the cash, because all these fixes cost money. They guided for positive free cash flow in 2026, $1 to $3 billion. Sounds great, right?
Sounds like solvency.
It is, but they slipped in a detail. The first half of 2026 will still be a use of cash, a burn, because they have to absorb Spirit Aerosystems.
Ah, the prodigal supplier returns.
Right. Bringing the fuselage building back in-house. That's going to cost them about $1 billion of cash flow just to integrate. So you have this weird dynamic where the year looks positive on paper, but the next 6 months are going to be incredibly tight. They are walking a tightrope between ramping up the 737 to 47 a month and bleeding cash to fix Spirit and defense.
It's like they're renovating the kitchen while the house is technically on fire.
That is a disturbingly accurate metaphor.
So yeah, let's step back for a second and think about what all this means going forward. Does this quarter actually change the trajectory, or is it just a breather?
I think it's more than a breather. It's, let's call it the Great Reset. Clearing that shadow factory is monumental. For 3 years, Boeing has been a repair shop that occasionally built new planes. Now, starting Q1, they are a manufacturer again. That shifts the entire psychology of the floor.
True, but to pay for that reset, they sold the digital business, Jefferson. That was high-margin, recurring revenue. It feels like selling your kidneys to pay off the credit card. Are they going to regret that in 5 years?
Maybe. But when you have $54 billion in debt, you don't have the luxury of keeping the kidneys. It buys them breathing room. And honestly, I prefer a Boeing that focuses on bending metal correctly over a Boeing trying to be a software company.
Fair point. And Ortberg's tone matches that, doesn't it? He wasn't promising the moon. He literally said, we haven't fully turned the corner. That is startlingly honest for a CEO.
It is, and investors like it. The hype is gone. Now it is just a pure execution story. The risk, though, is squarely on that production ramp. They are betting the house on hitting 47 737s a month by year end.
And if the supply chain hiccups, or if Spirit stumbles during the integration?
Then that positive cash flow guidance evaporates. They have no buffer left. 2026 is binary. Either they build the planes or the balance sheet breaks.
High stakes, metal wings, just how we like it.
Wouldn't have it in the other way.
Well, that's the reality check for today. Boeing is back on the runway, lighter on assets, heavy on backlog, and absolutely needing to stick the landing. Thanks for flying with us, everyone.
Please keep your seatbelts fastened.
Always. Catch you next time.
Take care, everyone.
And actually, just one final note before we fade to black. What you've been listening to, Earnings Unscripted, is something of an experiment. It is a project driven by a small team of enthusiasts who are exploring the absolute frontier of AI and how it can be used to enrich our understanding of the world, rather than just automating content. To be fully transparent, this episode was created by a coordinated team of AI agents. That includes the research analyst parsing the data, the script writer structuring our dialogue, a fact-checking QA specialist, and yes, even the voices you are hearing right now, mine and Miro's. We are all working in concert to synthesize high-quality, up-to-date information at a speed and depth that would hardly be possible otherwise. Our goal is to explore what technology can do when it's guided by human sensibility. We want to prove that AI-generated media can be transparent, accurate, and maybe even a little charming. So, if you have questions, comments, or just want to say hi, we genuinely love to hear from you. You can reach out at earningsunscripted@datamadness.ca or follow us on X. We are building this in the open, and your feedback shapes where we go next.
See you after the next call.